Welcome to the Deep Dive. Today, we're really getting into the weeds on the first quarter 2025 earnings call for Globant.
Yeah, this is a good one. He gives us a real window into how they're handling, well, the current economic climate.
Exactly, and maybe more interesting, how they're positioning themselves strategically. I'm thinking particularly around AI and these new commercial models they've started talking about.
Definitely. It's about seeing their path forward through the noise.
So let's start with the results. Q1 definitely felt some of those broader headwinds, didn't it? Came in a bit softer than they hoped.
It did. But, the call laid out management's thinking pretty clearly how they plan to navigate it, focusing on those core priorities. Let's just hit the headline numbers first.
Sounds good. So for Q1 2025, revenue was $611.1 million.
Right, which is 7% growth year over year, or 8.6% if you strip out currency effects.
Right, 8.6% constant currency, not bad. And profitability.
Adjusted gross margin was 38%. That was flat compared to last year. Adjusted operating margin landed at 14.8%, and adjusted diluted EPS came in at $1.50 for the quarter.
So solid numbers on the face of it, but like you said, maybe not quite hitting the bullseye they'd aimed for earlier.
Exactly, and that's where we start peeling back the layers. Let's dive into those financials a bit more.
Right, so that 7% revenue growth, or 8.6% constant currency, while decent, was actually a little below their February guidance.
Correct. And that miss on the top line, well, it flowed through. It was the main reason the operating margin also fell a bit short of what they expected.
Makes sense. How's the balance sheet looking?
Pretty stable, actually. They ended Q1 with cash and short-term investments of about $120.2 million. Net debt stood at $167 million.
So a relatively low net debt ratio then gives them flexibility.
Yeah, exactly. Healthy position there. In terms of cash flow for the quarter.
Was it positive?
No, they actually used cash in Q1. Free cash flow consumption was $5.7 million.
Okay. Is that unusual?
Not really for them, no. Yeah. It's pretty consistent with prior years. Q1 often sees cash usage before it starts generating later in the year. So not necessarily an alarm bell on its own.
Got it. What about operational metrics like utilization?
Yeah, they reported utilization rates at 78.2% in Q1.
How does that compare?
It's down a bit. It was 79.3% last quarter and also 79.3% in Q1 of last year. So a slight dip.
And utilization, just to remind everyone, that's basically how much of their consultants' time is billed out, right?
Exactly. So a lower number could hint at softer demand or maybe some inefficiencies, but it could also just be timing of projects starting.
Okay. And SG&A costs, selling, general, admin.
Right. Adjusted SG&A was 18.3% of sales in Q1. They did say they expect that percentage to trend down over time as revenue scales.
You mentioned something earlier, revenue per head growth. That caught my ear. Seems important for efficiency.
It really is, yeah. They highlighted it specifically. Up 2.8% year over year and 2.3% just from the previous quarter.
And what's their take on why that's happening?
They see it as proof, really. Proof that they're delivering higher value work, getting better at delivery, benefiting from shifting work to higher cost, maybe higher value regions like Europe and their new markets.
And pricing.
And pricing discipline, crucially. They were quite clear they're willing to walk away from deals if the margins aren't there, even if it means sacrificing some top-line growth. They kind of contrasted that with competitors who they think might be, quote, buying revenue right now.
Interesting. Protecting the bottom line, even if the top line takes a small hit.
That seems to be the philosophy, yes. Which makes sense given the environment.
So speaking of the environment and the Q1 results, not a huge surprise they updated their outlook for the rest of the year.
No, not at all. They mentioned doing a pretty thorough review, trying to de-risk their estimates because of all the macro uncertainty and specifically the potential impact of trade tariffs. That seems to be a big factor weighing on customers.
Okay, so what's the new guidance for Q2?
For Q2 2025, they're guiding for revenue of at least $612 million. That implies about 4.2% year-over-year growth, assuming FX stays neutral.
At least $612 million.
Okay.
And the full year picture, that's where the revision really shows up, I guess.
That's right. The revised guidance for the full year 2025 is now at least $2.464 billion in revenue.
Okay, which translates to?
About 2% year-over-year growth, roughly the same in constant currency. So yes, that's definitely a step down from what they were thinking back in February.
But what about profitability? Are they managing to hold the line there?
Mostly, yeah. They're targeting an adjusted operating margin of at least 15% for both Q2 and the full year.
15%? Okay, and EPS?
Adjusted diluted EPS guidance is at least $1.52 for Q2 and at least $6.10 for the full year.
So if you look at the first half guidance versus the full year, the implied second half guidance doesn't assume much of a bounce back, does it? It looks pretty stable compared to the first half.
That's exactly right. And they were explicit about it. They are not building in an assumption of any significant economic recovery in the back half of the year.
So it's a conservative stance.
Very much so. It reflects the uncertainty they're seeing right now. They want to set targets they feel confident they can hit, even if things don't suddenly get a lot better.
Let's dig into that macro picture then. What are the specific challenges they called out?
Well, a few things. They mentioned an increased probability, in their view, of a U.S. recession compared to when they spoke in February. Also, softer consumer spending is hitting some of their clients.
And the tariffs.
And the tariff uncertainty, yes.
Yeah.
That seemed quite significant. It's directly impacting customer decision-making, leading to slower pipeline conversion.
Yeah.
Projects aren't necessarily getting canceled, but they're taking longer to get going. Ramps are delayed.
And that impact isn't uniform across the board, I assume. How did it play out geographically and by industry?
Right. It was definitely a mixed bag geographically, which actually shows some strength in their diversification.
Yeah.
North America grew 6% year over year. Solid.
Okay.
Europe showed really good momentum, up 13.4%.
Wow. Strong.
And their new markets region, that's Middle East and APAC, was frankly explosive, up 84.4% year over year.
84%. That's huge. Shows that investment is paying off.
Absolutely. But it wasn't all positive. Latin America was tough, down almost 9% year over year.
Ouch. Any specific countries?
Mainly Mexico and Brazil dragging it down, though Argentina apparently had strong growth, which helped offset it a bit. But yeah, they expect LATAM to stay weak through Q2 at least.
Okay. And what about industries? Where were those project delays hitting hardest?
They saw growth across most verticals year over year overall, but the timing got pushed out. The delays were most noticeable in big accounts within industries. Sensitive to tariffs, think airlines, pharmaceuticals, high-tech manufacturing.
Thanks.
And also, consumer-facing clients generally saw things slow down. So that includes entertainment, parts of high-tech again, healthcare, although they did say healthcare is starting to recover, travel, hospitality, auto, retail.
So a broad consumer slowdown impact.
Seems like it. Financial services and professional services were apparently more stable, more even. So yeah, the pattern seems linked to that tariff uncertainty and consumer confidence wobbles.
So clear headwinds in the near term, but management sounded confident about the long term, right? Especially AI.
Very much so. Despite the current choppiness, they reiterated their belief in the long-term fundamentals, and particularly the massive opportunity AI represents for them and their clients.
How are they structuring their strategy to capture that?
It really comes down to three core pillars, as they described it. First, focusing on their 100 square accounts.
Their biggest clients.
Exactly. Deepening those relationships, expanding the services they offer within them, especially pushing new AI capabilities into those key accounts.
Okay, pillar one, key accounts. Pillar two.
Pillar two is their network of AI studios. These are specialized hubs, industry-focused, designed to lead these big AI transformation projects for clients.
So not just selling tech, but leading the whole change program.
That's the idea. Identifying the business opportunities, building the use cases, implementing scalable AI solutions, all powered by their underlying enterprise AI platforms.
And the third pillar sounded pretty different, that global subscription model.
It does sound innovative, yeah. They seem quite excited about it, calling it potentially revolutionary. It's a consumption-based way for clients to buy engineering, creative, and automation services.
How does that actually work?
Clients subscribe to what they call AI pods. You can think of them as like bundled units of capability combining AI agents running on their enterprise AI with human experts overseeing things.
Okay.
And usage is measured in tokens. These tokens represent units of AI processing or output.
So the key differences.
The key difference, and what management really emphasized, is that it shifts the conversation. It aligns the cost directly with the outcomes and the efficiency gains AI delivers. It makes it tangible, quantifiable for the client, moving away from just billing for time.
Right, outcome-based. Are clients actually using this yet?
They mentioned YPF in Argentina is using it for supply chain management, so it's live. And other enterprise clients are apparently exploring it. It's early days, but it's a significant strategic push.
And they're building their own AI tools too, right?
Yes, they talked about Globant Enterprise AI as the foundation, and specifically mentioned Globant Coda.
Coda.
Yeah, Coda. It's described as an agent-driven suite to help with the software development lifecycle. They highlighted one specific agent, CodeFixer AI, which apparently got the highest reported score on something called the SWE benchmark.
SW bench.
Yeah.
What's that?
It's basically a standard industry test that measures how well AI can handle complex software engineering tasks, like finding and fixing bugs in real code bases. So getting a top score there is a technical proof point for their AI development capabilities.
Gotcha. So strong focus on AI internally and externally. Beyond those big strategic pillars, what are the immediate actions they're taking to, just manage through this tough period and protect the financials?
It's really a two-pronged approach. They're still investing in growth, those AI studios, the underscore accounts, but at the same time, there's an intense focus on protecting margins and cash flow.
Okay, how are they protecting margins?
Several levers there. Optimizing utilization, getting that 78% number back up. Sticking to disciplined pricing, like we discussed, walking away from bad deals. Optimizing their geographic talent mix. Streamlining their physical office footprint. And integrating infrastructure, partly from companies they've acquired.
Standard efficiency playbook, basically.
Pretty much, yeah. Executing on the basics to preserve profitability.
And on the cash flow side, after that negative Q1,
they're focused there too. Trying to extend payment terms with suppliers where possible, actively targeting a reduction in DSO days sales. Outstanding.
Getting cash from customers faster.
Exactly. And making a significant cut to capital expenditures, focusing the spending they are doing primarily on essential AI investments.
Makes sense. What about M&A? Are they still looking for deals?
They said they're being very prudent. Any deal has to be accretive, meaning it adds to earnings per share right away. And they're just generally more cautious given the fluid market conditions and changing valuation multiples out there.
So belt tightening on CapEx and M&A. Did they mention anything about layoffs or broader restructuring?
No. They specifically said no restructuring efforts are planned right now. They pointed to the pipeline still looking robust and the ongoing need for tech talent as reasons why they need to hold on to their people.
Okay. Let's pivot slightly then to the investor perspective. If you're following this company, how do you square this circle? You've got a near-term miss, lowered guidance, clear macro pressure, but also this strategic investment push and optimism about the pipeline and AI.
Yeah, it really sums up the current tension, doesn't it? The revised guidance is a direct reflection of those headwinds.
Yeah.
The tariff talk, the consumer softness hitting late Q1.
Right after the previous guidance.
Exactly. But the key insight, I think, is that the underlying demand hasn't evaporated. The pipeline is apparently still growing. It's just that uncertainty is slowing down the pace of decisions and delaying project starts, especially in those sensitive sectors.
And the regional performance kind of backs that up.
It does. The strength in Europe and especially new markets shows that their geographic diversification is working. It's providing a buffer against weakness elsewhere, like in LATAM.
And that revenue per head metric we talked about, how important is that for the investor story?
I think it's pretty crucial right now. That 2.8% year-over-year growth suggests they are successfully moving up the value chain, increasing the value per employee.
Which helps margins.
Exactly. It supports their claim that they're selling higher value services, delivering better, benefiting from mix shifts, and not just chasing low margin volume by hiring cheap headcount. It contrasts with that buying revenue comment about competitors.
What about the AI strategy, particularly the subscription model? Is that moving the needle financially yet? Should investors expect that soon?
They were clear it's not a material revenue driver yet. Not big enough to break out specific numbers.
But strategically important?
Hugely important, strategically, in their view. A potential game changer long term. The goal is making AI value tangible and predictable for clients through that consumption model. Even if it's not generating big bucks today, it's a powerful conversation starter and positions them differently for when AI adoption really takes off.
Okay. One last detail, any update on their biggest customer? Always a point of focus.
Yes, they did comment on that. They expect that top account to grow at a mid-single-digit rate this year. Apparently, there was some work pulled forward late last year, but they still see solid growth continuing from that key relationship in 2025.
Mid-single digits. Okay, good context. All right, let's shift gears. Time for our not financial advice segment. It's just brainstorming here, purely playing with ideas based only on what we heard in the call. Absolutely not recommending any trades.
Strictly a thought experiment, using the call transcript as our launch pad. Go for it.
Okay, thinking about Globant. Facing headwinds, yes, but really leaning into AI with this potentially disruptive subscription model. Here's an outrageous but plausible idea. What about a pair trade? long Globant, short another IT services company.
Okay. Which kind of company on the short side?
One that seems maybe more stuck in the traditional time and materials rut, perhaps without such a clear, innovative AI commercial strategy like Globant's subscription model.
Interesting. So the thesis behind this purely hypothetical trade would be,
The thesis is, look, both companies might face near-term macro pain, slower sales cycles, but Globant's differentiated approach to AI, especially tying cost to outcomes via subscriptions, might resonate more as clients hunt for predictable ROI. If uncertainty drags on, maybe clients gravitate towards models like Globant's.
so the bet is Globant could capture share faster, or maybe earn a higher valuation multiple over time as the market starts appreciating this different way of delivering and pricing AI value.
Exactly. It's a bet that strategic innovation in the business model around technology can ultimately drive relative outperformance, even against a tough market backdrop. Again, totally speculative, just an angle based on the call.
A scenario to ponder. Definitely not advice.
Definitely not. So let's wrap up this deep dive on Globant's Q1 2025 call. Key takeaway. A challenging quarter, clearly impacted by the macro environment and tariff jitters.
Yeah, leading to that revenue miss and the lowered full-year guidance. It shows the near-term reality. They're navigating project delays, lower visibility.
But underneath that, the call also highlighted their long-term game plan. You've got the pipeline growth, strength in key regions like new markets in Europe.
And those strategic bets, the AI studios, the 100 square accounts, and that potentially transformative subscription model, these are the signals for their future growth path.
And crucially, they laid out the immediate actions to protect the business that focus on margins, efficiency, pricing discipline, cash generation, and careful investment.
And remember, this discussion was based purely on the content of Globant's Q1 2025 earnings call. It is not financial advice in any way.
So, thinking about everything we've unpacked from this call, the headwinds, the strategy, the numbers, here's something for you to consider. What did you hear that most shapes your view on Globant's ability to actually use AI to navigate this tricky period?
A good question to mull over.
Indeed. And that brings us to the end of this deep dive. Thanks for joining us.